Today's video, we catch up with Josh and Ehren, and we discuss what their thoughts and opinions are for the future of mortgages and interest rates.
The market in general right now has seen unprecedented growth, which obviously nobody could have predicted when COVID started last year. Nobody sue us, this is just our opinion. But the economy in general, some numbers came out the other day that said that possibly GDP growth is going to be a lot higher than what we initially predicted.
Inflation is going to start to go back up a little bit, and in return, we're going to start to see the prime rate and the Bank of Canada rate go back up. I think the big question is just what does that mean for mortgage rates, and what does that mean for buyers right now who are looking to choose between a fixed rate or a variable rate, and how their future is going to be affected by that.
What is up, YouTube? Matt McKeever here, and in today's video, we catch up with Josh and Ehren, and we discuss what their thoughts and opinions are for the future of mortgages and interest rates. Now, obviously, no one has a perfectly working crystal ball, but it's kind of fun to be able to sit down and just talk through with the guys what our thoughts and opinions are. I'd love to hear your thoughts and your opinions in that comment section down below, but let's jump into today's video. What is up, YouTube? Matt McKeever here, and we've got Josh and Ehren back from the Findlay Mortgage Team. Hey guys, how's it going?
Good, man, good.
So today we decided we'd break out our crystal balls and start talking about the future. I know everyone loves it when we like to just throw out random predictions, so that's what today's show is going to be. Obviously, our crystal balls are worth what you see them to be. No one's crystal ball is 100% accurate, but it is fun to at least use this as a mental exercise to talk through some of our thoughts and opinions in regards to where maybe mortgage market's going to go, where interest rates are going to go, and even just how that may impact the greater economy and real estate investing in general. So, where do you guys want to start the predictions?
Yeah, so there's a handful of things that we have to take into consideration. The market in general right now has seen unprecedented growth, which obviously nobody could have predicted when COVID started last year. We have people all the time asking us, whether it's professionals in our field, whether it's the lenders, brokers, whoever it is, everyone's wondering what's going to happen. So we decided to sit down and mastermind and kind of look at the historicals of what has happened in past recessions or past slowdowns in GDP. We wanted to figure out, historically, what did that look like when we come out of that and into like a growth phase of the economy, and what's it going to mean for interest rates and for all of our buyers and investors. So, it's kind of, it's an interesting question that nobody really knows, obviously, so nobody sue us. This is just our opinion. But, the economy in general, some numbers came out the other day that said that possibly GDP growth is going to be a lot higher than what we initially predicted. And they're expecting about 7.8%, which is, if anybody keeps track of it, that's a pretty big hike in GDP growth. Obviously, that was for Q4 of 2020, which had just ended, so those numbers are coming out now. Important to take into consideration that that was a time when we weren't under lockdown, like an extreme lockdown. So obviously, I think maybe the Q1 numbers for 2021 might be a little bit lower just because we are under lockdown again and strict guidance not to go anywhere or do anything. But the growth is definitely something that we see as a positive note. I think if our economy can grow that quickly, I think that when our economy moves back into a form of growth, I think we're going to see interest rates rise at the end of the day. And to be able to see that, we took a look at some historical data. Currently, I think I'm getting a little bit ahead of ourselves now, but back in 2008, we took a look and analyzed the data for the overnight lending rate and the Bank of Canada rate. We're actually at the exact same level right now as to where we were back in 2008. So, as you see the recovery happening, interest rates do stagger and go up. So we'll get into that a little bit later, but on the positive note, in the next 3 years, we definitely see rates going up.
Yeah, I think, it really just comes back to the economy and how the economy is doing. Like Josh said, if we start to see a positive increase in the GDP, that means the economy is doing a little bit better. There's a little more cash circulating in the economy. So the affordability of, the society is there. Inflation is going to start to go back up a little bit, and in return, we're going to start to see the prime rate and the Bank of Canada rate go back up. I think the big question is just what does that mean for mortgage rates, and what does that mean for buyers right now who are looking to choose between a fixed rate or a variable rate, and how their future is going to be affected by that. I think it was last year, in and around the March area, when COVID first started to come out and the economy was first starting to kind of be affected. there was a interview done with the head of Scotia Authority, and he was talking about how the prime rates were so low and the Bank of Canada overnight rate was so low because essentially what they were trying to do was avoid a credit freeze and just maintain society and allow them to continue on with their everyday lives. As people were either getting laid off or potentially losing their jobs, they were going to rely more on their lines of credit and credit cards. So they just wanted to make sure that system was accessible and free flowing. In return, we saw super low variable rates. The rates are the lowest they've ever been, I think, at an all-time low. So great for buying, but what does that mean on the bank side? Banks have margins, their businesses. One of the things that he talked about are these rates, are they underwater or are they sitting right at water level? Either way, the lower rates have really minimized the margins for the banks. And as Josh said, as the economy starts to grow and get back to normal, those rates are going to go back up. The banks have to make up for those margins, and the banks are businesses. They're going to want to make up those margins and have that, larger increase in revenue. So, how quickly does that happen, I think, is the real big question. Even if you're looking at a minimum 3-year term, if you lock in now or you get that mortgage rate now, you're taking a look at the next 3 years, and that's the next 3 years are going to be directly impacted by COVID. If the GDP starts to increase and we see those go back up, those variable rates and the prime rates, most bank rates are increased by 25 basis points at a time. Right now, currently, the variable rate is sitting about 30 basis points below a fixed rate, I believe it is, on average. With one rate increase by the Bank of Canada, you're pretty much on par with a variable and a fixed rate mortgage again, since fixed rates aren't reflective of the overnight rate. At that point in the next year, or even the next 3 or 4 months, I suppose, depending on how quickly things start to change, if we see that rate, it comes down to that rate increase. It kind of poses the question, should people continue to go variable rate or do they lock in their variable rate? I think it comes down to, what are you comfortable with? Do you have the excess capital to be able to afford your mortgage payment increasing in the next year? If you're a renter, an investor, and you have cash flowing properties, how much are your properties cash flowing? Some of the residential properties we see, I say they cash flow anywhere between $2 to $3 to $5 to $6 or $700 a month. If you're in that $200 to $300 cash flow area and your variable rate mortgage starts to increase, how much room do you have before you're really either breaking even or you're no longer cash flowing, right? So just the things to consider, currently, if you're in a variable rate, is it worth locking in? Or if you're looking to purchase, is it worth going with a fixed rate and just locking that in for the next 5 years? Because even the fixed rates are at historical lows right now.
Mm-hmm.
Yeah, I think it's definitely an interesting time in the economy. For myself, it's hard to know, the moment we start trying to predict more than like a couple days out, I start to really have a foggy crystal ball. But for myself, I definitely see the Bank of Canada wanting to position themselves from a hawkish narrative, but I secretly think that these are doves dressed as hawks personally. So for my opinion, I could see like what you guys have mentioned over the next 3 years. Could we see 1 or 2 token raises? I definitely believe that, because I think that helps at least create the illusion that we could go higher with interest rates. And for me, it becomes a really big conversation when we start looking at interest rates, right? Can we really afford to decouple from the US and their economy, right? Like if their economy doesn't rebound the same way, or if their economy rebounds in a different way, are we really going to have essentially the economic strength to really separate from an interest rate? And then the other aspect is just all this stimulus spending, right? So obviously at some point in time, someone has to pay that bill, and the higher the interest rates, in theory, the more expense that's going to be involved with that. So I do have a hard time seeing how, honestly, in my lifetime, how we could ever see really high interest rates again, just because of the nature of the economy. Now, again, with a monetary reset or other crazy things, I could definitely go down that path and understand how we could see some sort of change in the interest rate environment. But I think the biggest question is, and you did a good job, Ehren, of bringing it up, is like, as an individual investor, what actually matters to me, right? Like, we could spend an entire lifetime trying to become experts at being being able to interpret GDP and things of that nature, because again, like even when we talk about something like inflation rates, right? Like there's the CPI and then there's what I'd argue to be real inflation. And so oftentimes it's very easy for government organizations to manipulate like the broad basket of goods that are in a CPI, right? And so when we're looking at all these different factors, I actually think it's almost impossible to be able to predict the future, just because there's too many variables and it's too difficult to understand which variable is important in this moment and going to actually have the greatest impact. But we can actually take a step back and focus on ourselves. And so as an investor, what's most important to you? And in fact, I personally am of the opinion that for a lot of investors, playing the game of trying to squeeze every penny of profit out of interest rates is a losing game. If you're only focused on saving money or reducing expenses, you're really going to be ignoring growing the top line. And that's one of my greatest fears when people get too obsessed with trying to get the absolute lowest interest rate, is that you're focusing on this one thing that actually doesn't move the needle too much compared to a lot of the other decisions that we do have direct influence over as an investor. So I know for us personally, when we stabilize a building, we're usually going to have a bias towards just fixed payments and knowing with certainty. So that means that we're probably going to lean towards a fixed interest rate. Whereas in short-term projects and things of that nature, we can be a bit more dynamic if we know that we're going to be in and out within a year or two, because again, our usual assessment of the risk of say like seeing more than one or two hikes of 25 basis points in a given year seems a very low probability of happening. So for us, that's how we're often going to approach it. But I can remember being a new investor and being obsessed about interest rates, right? And one of the first quotes that you'll hear any new obsessed real estate investor say is that historically speaking, variable rates have always been better than fixed rates. Historically speaking, that's true. I think that an argument could be made at this point in time that we're not in historically normal times. And so because of that, again, there's so many variables here. When you're at historically low interest rates, how much lower can it go? Could we go into negative interest rates, right? As well as what sort of pressure is on the government to position narratives in a certain way, because it's also important to understand that at this point in our news cycle and mainstream media, it can be very easy for a headline to become the reality. And so I think that's where we see a lot of this hawkish talk coming out of the Bank of Canada and regulators, because it is good for us to believe that they're capable of raising interest rates. Because if the system, if the economy loses all faith in the ability for the government or the Bank of Canada specifically to raise interest rates, I think that again, it's going to undermine everything that we've got going on. So I do think it's a really interesting subject matter, and I just want to encourage every investor, like, focus on what matters to you, right? Like, you can actually get on the phone with your mortgage agent and talk through and figure out what happens, right? What sort of fees? Is there a fee involved with converting my mortgage product, right? We can take a very proactive stance here if you guys are concerned about that. But the other thing I'll say is that unless we've stabilized the building, if you're flipping a property, if you're burning a property, if you're actively taking on a project, if the difference of 0.25 makes or breaks your business model, I think that you're on the razor's edge already, and you actually should be panicking not because of an interest rate, but because of a bad business model. So yeah, it's really fun to get to explore these subject matters, because again, I think far too often people, they either want to argue a point or they want to argue no point. And what's actually important is like, what's the points that matter to us as investors?
Yeah, I just want to jump in quick, and I think you said it really correctly. And the biggest thing to take away from this isn't whether we're right or wrong, but it's about, just thinking about what position you're in and where you want to be in the next 5 years and what is important to you. And it's really just taking a step back and figuring out what do you need to succeed, and just being prepared for that. Not necessarily we're right or wrong, but if you put yourself in a position that fits your model, that's really all we're trying to do, is just get the investors and the buyers thinking and just figuring out what they specifically need.
It's funny because this moment flashes in my head of, if anybody remembers The Big Short and how Steve Carell went to go talk to, it was a stripper at the time, and she was talking about how many houses she had, and she's like, no, I got like 10 houses, but they're all variable, and it just like clicked. He's like, oh damn, like all these people are super leveraged, and when they jack interest rates up, all these people are going to be underwater, right? So it's that moment that makes you think about these questions. Make sure that your portfolio is is set, or that you're ready in case a few years from now, interest rates do jack up and you're able to either cash flow these properties or pay for your properties or reposition your portfolio to be able to, act in case something were to happen. And I think this Black Swan event definitely put it in perspective for the larger investors that we have. They now understand that you're not 100% always covered, and to add that tactical bit to your strategy now is important if you want to survive in today's economy.
Mm-hmm. Yeah, absolutely. And I think the other thing that we want to talk about too is just how this market is affecting the market from a purchaser standpoint. Obviously we're starting to see first-time home buyers and these lower level markets really get overpriced, if you want to quote that, and the first-time buyers are really getting priced out of the market. I was talking to, and it's actually kind of funny because when we first started working really closely with you guys, Windsor was the rage. Everyone was buying Windsor. Everything on our desk was Windsor. And I was just talking to a client the other day who was talking to the city, and the lady who was talking to was kind of joking, but she's like, you guys are really making it impossible for people to buy homes in Windsor now, because things are now $400,000 as opposed to the 200, 250, 299 that we were seeing 10 months ago in the Windsor market. And there's a few investors that I work with who like to buy houses in cash in Windsor, and even for them, they're like, I've never been outbid on homes before in Windsor, and I just got outbid 5 this week. So we're really starting to see the effects of the investors in the BRRRR strategy in a market. And I'm not saying it's a bad thing, but it's just the outcomes are there and the effects are there. And I think the long term, when you're looking forward is what it does to the rental market. Obviously, the first-time home buyers, like I said, are starting to get priced out, and there's going to be a certain level of buyer who just isn't able to keep up with the price if home values obviously continue to inflate, and that's going to create a real need in the rental market. I think the rental market is already pretty low in inventory. So for the investors, that might be something to be able to pick up on, and even for the people who aren't investing, if you can afford it and you have the capital to be able to get in, maybe that's an investing strategy that you want to start taking a look at, knowing that need for multifamily rentals is going to be increasing as we continue to see the increase in home values.
Yeah, so all of our large multifamily buyers that we deal with, even talked to Mark Smith, and he started getting into large multifamily wholesaling, and the amount of offers that are going in on these large multifamilies now is insane. I think I heard of one of them in Windsor going for 30. There's like 31 or 32 offers on a single multifamily property. So the appetite there for people who have very deep pockets, they see it coming. They see the writing on the wall. A lot of people are getting priced out of homes, and those people still need a place to live, and quality places to live. We're not telling you guys just to be slumlords. Like buy large property and put people in places where they have a great place to live. But we definitely think that the growth in that market is going to continue to grow as income doesn't quite grow at the same pace as housing prices do. And I think Windsor was not one of the last ones, but there are very few places now in the Ontario market that are really, really affordable to be able to buy a single family home anymore.
Mm-hmm. Yeah, the market's definitely evolving. It's interesting to see all these dynamics, and again, it'll be interesting with hindsight to look back on these videos and be able to see what actually shaped up. But again, I think what's really important is to understand what's in our control, right? Just the other day I put out a tweet saying that for the last 10 years people have been telling me how the real estate market in Canada is unsustainable and about to crash, and who knows? But over the last 10 years, I've been building an empire. And I think the real key is, again, to focus on what we've got control over, right? So really looking at your personal situation and figuring out, does this impact me, right? And that's where we can really dive into signal versus noise, right? The signal is what's actually going to impact you as a real estate investor. The noise is just like the fear mongering, right? The panic, the what ifs, the what ifs, what ifs. It's really important we focus on what we've got under control and what we can have influence over, and then just navigate the dynamic nature of the economy, because I'm willing to predict one thing: the economy will absolutely continue to be very dynamic for the foreseeable future. There's just too many. To me, it almost feels like a pendulum, and and it's just constantly swinging from one extreme to the other. And a pendulum just doesn't stop at a moment, right? It actually takes a while to wear itself out. So presumably at some point in time it'll wear itself out and we'll find ourselves in the middle. But until then, I think we'll continue to see a lot of volatility in every market in every sense, right? Right now we've got historically low inventory levels on realtor.ca as far as real estate properties available for sale go. Most markets in Ontario right now are under 1 month's inventory. This is insane. And again, this is one of those unusual, abnormal moments in time where there's great opportunities, but there's also a lot of risk involved. And again, that's why it's so important that we just focus on what we've got control of.
Completely agree. And, looking forward, Aaron and I always try to be, 5-10 years ahead of where are we going to be, where are you going to be, where are buyers going to be. And one of the most interesting aspects that most people don't touch on is the amount of wealth that is about to be passed down from generation to generation. The baby boomers were by far the largest generation that had ever graced our earth, like ridiculous amounts of them. And they all took advantage of the rising in house prices. They all have lots of equity. The majority of them, if they bought any houses, they're millionaires now. All of that wealth is going to be passed down to the next generation, their children and their children's children. And what is the mentality there? I mean, we target the majority of our clients, we look at our demographics, it's 24 to like 32 in Toronto, males, but they all have the same mentality. How do I grow my wealth? Like my parents did it. How do I figure out how to do it? And how do I make those smart decisions moving forward? And I think a lot of the next generation, I think millennials is what we call ourselves, I guess, but we have such opportunity now in the world to be able to do whatever we want. And now with the access to capital that they're about to have, I truly believe that it's going to increase the demand for rental properties, the demand for purchasing real estate, and that's going to drive prices even higher. Obviously, the sustainability of it, I'm not an economist. I don't really know, but that amount of wealth transfer doesn't go unnoticed. And I think that the smart ones are the ones who are more informed, which is our generation, the ones who have access to the instantaneous news and the ability to be able to watch these videos or to understand markets much more effectively than what our parents were able to do or to keep up with. I think you're going to see a really interesting change in wealth and how that's going to be distributed in the future.
Mm-hmm. And I think, another big thing is stuff like this, content and media and social media, and how much of this is on, is right in front of everyone. I think you look at the generation younger than us that are coming up, I think there's a bit of a change in the dynamic in terms of what they want to do as a career and a job. And we're seeing, social media, people are one of the least barriers to creating a high amount of wealth. You don't need you don't need to go to school for it. You don't need this a set of skills that you have to take 4 years in college or university, get a degree, and have that. You can start. There's people 16, 17 who are starting and are creating social media content that's producing high amounts of wealth. And I think the more that we advertise real estate on social media, people are looking for alternative jobs other than sitting behind a desk. And if real estate investing is one of those, more and more people are going to get into the real estate investing field as well too. And I think that's just going to kind of perpetuate the cycle of investors coming up, people looking for other ways to build that wealth without getting a 9-to-5 job. And I think one thing, you kind of touched on this a little bit, is people kind of lose sight of real estate investing and kind of the stock market, and they think it is, this is way more safe. And it might be more safe, and I do agree in some aspects, but there still is risk when investing in real estate. There are obviously market crashes. There was 2008, and then there was that little bit of a bubble pop in 2016, 17, I think it was. But the important thing to remember is that it does cycle. There are crashes and dips and lows, but there are highs as well too, and it's really just understanding the market and being able to weather the storm and having the comfortability and the security to be able to ride that out. If you're someone who is going to, drop everything and sell at the point of you starting to see home values starting to dip a little bit, are you really the person who should be investing? I don't know, because if you're able to stick through that and ride it back out and understand that, your value and your equity might be decreasing, but if you have a cash flowing property, the chances are that as the dips are happening, I can't see your cash flow diminishing. Your cash flow isn't sitting specifically tied to your property value. So just understanding that there are going to be dips and highs in the real estate market as well too, and that you will need to weather those out. And real estate's all about timing, just as much as it is stock investing as well too. So.
Absolutely. So that's it for our predictions, guys. We'd love to hear your thoughts, your opinions in the comment section down below. Let us know. What do you think is going to happen in the future in regards to interest rates, house prices, and all the above that we talked about? Again, I think it's really important that you guys also focus on what's under your control and what's actually going to move the needle for you as an individual. If you guys want to get in contact with Josh or Ehren, we're going to throw a link in the video description down below. You guys can get in contact with them. You can always book a call with them. And again, even if you just want to pick their brains about maybe the future of interest rates, I got a feeling they'll humor you on this. So really appreciate you guys coming on the channel. If you guys got value from this video, smash the like button, hit subscribe if you're new to my channel, and we'll see you on the next video. Thanks again to Josh and Ehren for sharing their opinions when it comes to what they think is going to happen in the real estate market, and especially what's going to happen with the mortgages and interest rates for us real estate investors. I'd love to hear your thoughts and your opinions as well, though, so jump in the comment section and let us know where you think things are headed.